It's time for the profit deep dive, and today we put the spotlight on Poonawalla Fincorp. The stock has been underperforming this year, down 30% from its 52-week highs. Hiral joins in to tell us what is or what might not be working for the company. Hiral, over to you. Good morning.
Good morning. Absolutely, if you see in terms of what's not working, it's clearly seen in the price performance. With regards to fundamentals, we'll see going ahead, but down almost 18% on a YTD basis. And if you see the performance from its 52-week high, the stock has given up almost 30% kind of gains. Now, let's look at the valuation picture first, which is the price to book value. Overall, if you go to see in terms of where NBFCs go, this is that normal range where we could say it's richly valued between 3 to 4, but it's moved up from 0.17 times to almost 3.41 times, right? Now, whether is the street actually valuing it richly basis the performance, or is this the time to actually sell out and move out? That's the key question from here on. Just a quick one for all the viewers. What is book value? That's the amount of money that would be actually paid to shareholders if the company was liquidated and paid off all of its liabilities. And in terms of price to book value, that is the ratio of the market value of a company's shares price over its book value of equity. But moving from there on, if you see in terms of the AUM growth, from a 20,215 crore book, it's moved up to 28,396 crores. And this has mainly been led by MSMEs as well as consumer loans. And if you see in terms of the current AUM mix as well, that's going to be crucial, because what's happened is it's actually gone from 35% to 33% in terms of MSME. That's gone down. Personal and consumer loan has improved and increased as a share from 22% to 28%. Loan against property has increased. And if you see in terms of the others, they've remained pretty much as is. Now, from here on, what is the management's vision? 1.4 to 1.7 lakh crore AUM by FY30. That is a big statement that is coming from the management in the conference call. And what is going to aid all of this? So yes, the PL Prime, consumer durables, shopkeeper loans, you have used CVs, gold loans, where they're planning to open around 400 gold loan branches by FY26. So these are and education loans, right? So these are few of the segments which are expected to be added in terms of business. Now, I'm sure everyone's wondering, where is the problem? Now, what has happened is in FY24, the company actually went ahead and sold the secured loan book in the second quarter of FY24. That's the housing loan business. They garnered almost around 1,100 to 1,200 odd crores from this. But post that, now, if you see in terms of the new strategy, they're looking to scale the loan book mainly with the unsecured business. The key question here is, will the unsecured business help them in terms of the profitability? Because yes, your loan book will increase, but what will happen in terms of your asset quality? Now, from there, if you see in terms of the current mix, your secured is only 30%, whereas the unsecured is 70% for Poonawalla. So that's where the problem is. The asset quality has worsened from 1.36% to a 2.10%, and that's at a gross level. And overall, if you see in terms of the impairment, the interesting part was in the current quarter, 909 crore was the impairment. That's the provisioning kind of a number that they had made, versus a revenue of 996 crores, where 666 crores is the contingent provision. So it can go bad, it cannot go bad, right? So that's one of the crucial aspects we need to watch out for. And how quickly they utilize these provisions is going to be interesting, because the profits have been higher on lower provisioning. From 226 crores, we've just doubled to 471, and that's the number that they will work with. But if they utilize the provisions quickly, that will become cumbersome from here on. So what's not the next part, right? Now, will the ex-HDFC Bank team do the trick? Because majority of the management changes that have happened recently, of majority of the people coming in from HDFC Bank. Now, overall, you have Arvind Kapil, who's the managing director and CEO, ex-HDFC. Sriram V. Iyer, chief credit and analytics. Again, he's from HDFC. Vikas Pandey, who's the chief business officer, is an ex-HDFC employee. Apart from that, you have Virangan Raghav Iyer, who's an ex-HDFC Bank employee. So majority of the employees who've come in right now are coming in from HDFC. Now, whether the current, and a lot of resignations are happening as well. So an entire new team will they be able to manage the kind of guidance that has been given by the old management as well, is going to be interesting to watch out for. And very lastly, the key questions that we need to understand from here on is, will the company see steady growth with the new management? Moving from there on, will the new management be able to meet the guidance that they've given as well? Because the guidance is absolutely aggressive, and that also it will be coming in from the unsecured side of the business. And with that, how will the asset quality and the profitability be impacted? Because the utilization of the contingent provisions that they've made so far is going to be key. So a lot of questions from here on, and whether there is a re-rating with the new management is what we need to wait and watch.